When we published it a month and a half ago, it was 188,000 scam tokens that we mapped across 12 different blockchains. Every 4 minutes, a new one is deployed, so we're now over 205,000.
It's one thing to gamble and know that you're gambling. You know, if you go to Vegas for a fun weekend, sure, have fun. The risk comes when people don't realize that they're gambling and they're gambling.
Over 12,000 coins are listed across over 600 exchanges, and people are spending billions of dollars trading these crypto tokens. Most of these tokens were created just like the FTT tokens that Sam Bankman-Fried created for FTX, and some are even worse. Lyn Alden, who's a crypto analyst, is warning that a wipeout of most of these cryptocurrencies is inevitable. It's not a question of if, it's a question of when. Even after FTX's collapse, people are still speculating on thousands of cryptocurrencies that are extremely similar to FTT. Are you at risk? Let's find out from Lyn Alden.
If anything, it's funny, we've seen in the past week, we've seen kind of a rally in a lot of assets because we had sort of a top in the dollar index. Inflation came in a little bit lighter than expected. And that allowed a lot of things like that Bitcoin's been somewhat correlated this year, like gold and the NASDAQ, for example. They've rallied hard. And Bitcoin probably would have rallied pretty significantly this week if not for this industry-specific debacle. So it kind of sucks, obviously, in the near term. But I think in the long term, it almost couldn't happen any other way. That this kind of malinvestment, this kind of leverage casino stuff has to blow up. And it sucks for the users. But I think it's part of the process. I think malinvestment, by definition, has to die eventually. Otherwise, it was not malinvestment, right? And so if it is malinvestment, and I think we all agree that this was potentially fraud in addition to malinvestment, but so this was like a double whammy, right? But if you have malinvestment, it has to die eventually. And things that are just heavily built on speculation die eventually. Especially if, you know, like I said on my prior talk up here, that it's one thing to gamble and know that you're gambling. You know, if you go to Vegas for a fun weekend, sure, have fun. The risk comes when people don't realize that they're gambling and they're gambling. And so I view most of the, you know, kind of like FTX and similar things as almost like an extension of fiat. It's like late stage fiat. They took a lot of fiat ideas, like leverage and the necessary of interest rates, and kind of brought that into the, you know, quote unquote digital assets realm. And I think that the actual innovation is Bitcoin. The actual innovation is true decentralization, hard money, censorship-resistant transactions. That's the innovation. And like 99% or more of what we're seeing out there. I mean, there's interesting experiments, but anything that involves tokens and seigniorage and speculations and leverage is just like it's a scammy fiat kind of industry built on top of it. And it kind of has to blow up. And actually, when I was up here before, Alan Farrington made a good point that it kind of has to blow up together due to how interweaved we all found out it was. Now, there could have been a different timeline where there is more sideload leverage. It didn't have to be this interconnected, but it is natural for these things to develop like this. But because it turned out to be so interconnected, it kind of all had to fall at once, unfortunately.
Before the FTX dilemma, Bitcoin was beginning to recover from the severe plunge it had suffered in the year because of the unfavorable economic conditions that had affected not only cryptocurrencies, but all asset classes. As a matter of fact, it was the FTX situation that stopped the crypto market rally. Bitcoin in particular was performing better than the S&P 500, Dow Jones, and Nasdaq for several weeks before the collapse. Within about 24 hours, the crypto market had crashed by about 15%, losing an astonishing $150 billion. Now, it should be recalled that in the month of October, Bitcoin had outperformed the US stock markets. The crypto market was beginning to get a lot of attention as it was a more stable asset than most equities trading in Wall Street. It seemed that Bitcoin was decoupling from the volatile macroeconomic conditions such as high inflation, the strengthening dollar, the Fed's rate hikes, and the energy crisis. While a 15% crash was massive for the crypto market, it was even worse for FTT tokens. They dropped by 85% from around $19 per token to about $3 within a day. An incredible fall for a token created by one of the biggest crypto exchanges in the world. It can be argued that most altcoins in the market today don't even enjoy the privileges that the FTT token had. further highlighting the risks they pose if they indeed get stressed to the limit as FTX was. Other industry experts seem to agree with Lyn Alden that most cryptocurrencies are at risk of collapse because they're designed to work like Ponzi schemes. Interestingly, people also use Bitcoin to speculate, and it's made some of the biggest names in the investments and finance space, such as Warren Buffett and Jamie Dimon, to also call it a Ponzi scheme. While this categorization has been disputed, it's safe to say it all depends on how Bitcoin is being used. But the real danger remains the altcoins and tokens that are created and controlled by the founders. Before you proceed, hit the like and subscribe buttons. It lets us know that you love these analyses. Thanks. So how is Bitcoin different from other cryptocurrencies, and why are Bitcoiners confident it can't fail while others do? Lyn answers this next.
I think the first step is to understand the difference between Bitcoin and everything else in the space, right? So Bitcoin does not pass the Howey test, which is, I know it's jargon for some people, but basically it's a test that's been around for many decades to determine if something is a security or not. So Satoshi didn't raise capital. He just kind of put this open source code out there. He didn't pre-mine it himself. And there are multiple things, if you go through the step-by-step list of the Howey test, Bitcoin clearly does not pass it and therefore is not a security. Whereas when you apply that same test to other cryptos, the vast majority of them seem to pass that test and are likely securities, and some of them have been specifically ruled to be securities. Other ones is still technically gray, but when you actually look down at the list, you're like, it's probably a security or basically an equity. And so I think we need more clarity from exchanges, and I would agree that Michael gave a good talk about that. I think we need more clarity about regulation onshore. And I think the main thing is for policymakers to understand that Bitcoin is very different from everything else in the space, and that its nature is not inherently speculative in the same way that other things are, right? So you can speculate with Bitcoin. Many people do speculate with Bitcoin because it's a volatile new asset. People are going to speculate with it. But the underlying use case, why it was designed and the way that many of us use it, is not speculative. And I think I think we're going to see a bigger and bigger divide between the Bitcoin-only space and the rest of the crypto space. And I think over the past couple of years, with the rise of Bitcoin-only companies, we've seen that divide growing, I think, and it's only going to trend. And of course, there are other things like stable coins and things like that that are interesting too. But outside of, say, Bitcoin and stable coins, I think a lot of the other part of the space is really going to be delegated to the realm of casino land. It's things you're speculating on, and I think a lot of that's going to be, I think we've kind of seen potentially, and this famous last words, I guess, but it's like we've seen, I think, the high watermark in terms of how much speculation that can happen at once in this industry.
What is the Howey test that Lyn's talking about? According to Investopedia, the Howey test refers to the US Supreme Court case for determining whether a transaction qualifies as an investment contract, and therefore would be considered a security and subject to disclosure and registration requirements under the Security Act of 1933 and the Securities Exchange Act of 1934. Under the Howey test, an investment contract exists if there's an investment of money in a common enterprise with a reasonable expectation of profits to be derived from the efforts of others. Almost all tokens on the crypto market are being purchased with expectations of a return. The only exceptions are stablecoins. Somehow, Bitcoin has been caught in the web of this speculative use. The US Securities and Exchange Commission, or the SEC, has clarified that Bitcoin is the only cryptocurrency that's not a security. On Jim Cramer's show, Gary Gensler clarified that only Bitcoin was a commodity and cannot accept any other cryptocurrencies as securities, not even Ethereum, which many had hoped wouldn't be impacted by unfavorable regulations. Clearly, there would be new regulations that would set the record straight, but it seems only Bitcoin is out in the clear now. In 2023, cryptocurrencies are going to have a lot of problems to sort out. Besides regulations and passing the Howey test, there's the issue of shrinking liquidity in the market, which would test the resilience of many exchanges, crypto lenders, and even the cryptocurrencies themselves. How many would fail? Well, we're just going to have to wait and see.